Good morning, good afternoon, good evening, depending on where you are. Thank you for joining us today for the CDIR Policy Forum on Stablecoins, Tokenization, and Regulatory Responses to Distributed Financial Market Infrastructure. My name is Hugo Coelho. I'm Director of Policy at Financial Innovation for Impact, affiliated with the Cambridge Centre for Alternative Finance. Tokenization is reshaping how financial assets are issued, how they're transferred and settled. And in doing so, it is testing the limits of existing regulatory frameworks. As DLT is adopted more widely by traditional financial institutions, regulators face a set of urgent and consequential policy choices, from how to regulate stablecoins and other tokenized assets, avoiding arbitrage, to how to achieve resilience, accountability, interoperability in distributed infrastructures, and how to evolve their institutional mandates. Over the past years, we have published extensive research and promoted discussions on many of these topics. Today, we're launching our latest report titled Tokenized Assets, Pathways for Emerging Markets and Developing Economies. We're grateful for the support of the Foreign, Commonwealth and Development Office and for the engagement of more than 20 central banks, regulators, and market participants who contributed to the study. We hope the report advances our collective understanding of how tokenization can be governed, and more modestly, that it informs the debate today. We will start with the presentation of the key findings from the report by Keith Baer, a fellow at CCAF, and Hatim Hussein, the lead researcher of the report. We will then proceed with a high-level panel discussion. Keith, the floor is yours.
Thank you, Hugo, and hello, everybody. If we can move to the next slide. It's my great pleasure to present the key findings of our report, Tokenized Assets, Pathways for Emerging Markets and Developing Economies. The study asks a focused question: under what conditions can the tokenization of real-world assets scale responsibly in emerging markets and developing economies? The research we're presenting today builds on a series of reports published by the Centre, starting with crypto, moving through wholesale CBDC, other forms of tokenized money, leading to the analysis of this asset side of tokenization with a specific focus on EMDE. Our report has three objectives: to identify promising use cases for RWA tokenization in emerging developing economies, to investigate legal, regulatory, policy, and infrastructure pathways that can enable responsible scaling, and also to draw lessons from first movers and representative jurisdictions on how financial innovation can be harnessed for inclusive growth and deepening of capital markets. The report reviews the conceptual foundation, risks, benefits, and opportunities of asset tokenization, and reviews the associated regulatory environments and assesses the future direction. Next slide, please. So what is tokenization? What actually changes? Tokenization in this context is the use of blockchain and smart contract technology to represent financial or non-financial products and associated processes. Tokens can represent off-chain assets such as real estate, and they can also be the asset themselves, as in the case of a native digital bond. The precise definition, though, depends on a number of variables. For example, the type of technology utilized, the extent of reliance upon traditional financial service functions, etc. In this report, we have tried to make sense of this by assessing the impact on both market segments and asset classes, and the material differences between what has been demonstrated in pilots and what has been scaled commercially. We move to the next slide. So what are the use cases for tokenization? For the purposes of the study, we examined a number of use cases and the impact from tokenization to those product and asset classes in developed and developing markets. We can cluster these patterns into three categories. The first is asset issuance. These include the creation of financial instruments across asset classes, such as publicly issued equities, bonds, etc. Then we have short-term transactions, such as repo and securities lending. And finally, funds, where tokenization has had most impact, including tokenized money market funds and treasury funds. However, the focus in this study has been on the three categories on the left, i.e. real estate, commodities, and securities. So we think of this particular relevance for emerging markets for a variety of reasons. Markets are traditionally less liquid, and tokenization can democratize across equities, fixed income, and alternatives. In most markets, assets such as real estate, private credit, and private equity are difficult to access and invest in, so tokenization can create increased efficiencies on this front. In addition, just like M-Pesa in Kenya, now processing nearly half of the country's GDP, tokenization may allow emerging markets to leapfrog existing infrastructural bottlenecks and modernize capital markets. We can move to the next slide. Thank you. So are we there yet? As our kids may say, not really, as tokenized assets are still largely absent in EMDs. Tokenized markets with real-world assets at roughly 30 billion are a fraction of the $2.1 trillion in the crypto market, and also a tiny fraction of the market cap of the global stock market of around $100 trillion. And as you can see, there are a number of factors at play, but a primary one is the lack of liquidity in tokenized secondary markets. In some ways, this is a chicken and egg problem. We know that a lack of liquid markets for tokenized assets impedes investors to participate in a large scale. And at the same time, given the absence of a critical mass of subsequent investors, issuers may be reluctant to proceed with primary issuance of tokenized instruments. So a solid business rationale that would justify the cost of implementation of tokenization is currently lacking. Finally, an important consideration is the fact that for the benefits of tokenization to materialize, the payment rails need to be fully integrated with the DLT network. And until recently, the absence of forms of tokenized money could explain in part the absence of development of these markets. So just to spend a few minutes on settlement assets as a constraint, obviously settlement assets have been the subject of many initiatives over the last couple of years. And as you can see, there are a range of options available, but central banks and regulators are taking quite different approaches in many cases. With CBDCs being effectively banned in the US, the focus there is increasingly on regulated stablecoins. In Europe, the Pontis and Appia initiatives from the ECB point to real-time gross settlement synchronization and wholesale CBDC as the way forward. And in the UK, the Bank of England Synchronization Lab, Digital Security Sandbox, and the DLT Challenge, together with the wholesale pilot of the Great Britain Tokenized Deposit Network, point to a structured evolution of settlement asset choices, which leaves the major questions for EMD countries if there is no domestic wholesale CBDC or tokenized deposits available and no local fiat-based stablecoins. What is the pathway forward? Although there may be some tension between central banks and industry, as we can see from our wholesale CBDC report, there's a risk of a widening gap between markets becoming tokenized and the speed at which central banks can deliver central bank money-based settlement assets, which increases the risk of constraints for EMD tokenization or a growth in stablecoin-backed settlement. If we move to the next slide, just to give you some insights from the interviews on the market participants from our study, the quotes here show and emphasize the size for the potential for asset tokenization in EMD, but also the need for a path to increase market liquidity given the chicken and egg problem. And whether this will come from fintech innovation or regulatory and central bank initiatives, and also how this could be facilitated by public and private collaboration. So let me pause there and hand over to my colleague, Hatim.
Thanks very much, Keith. The market for tokenized assets are scaling fast. I think you've already established that. But the real question is whether existing regulation and institutional arrangements have adopted to allow it to scale responsibly. Now, this is a complex challenge, and to our understanding, no settled approach has emerged yet, especially in EMDEs. As we noted previously, tokenization concerns a range of asset classes and activities that are already subject to securities, banking, payments, and market infrastructure rules. So enabling tokenization will therefore require changes across those regulatory frameworks. So that governs different activities, products, and infrastructures. And a related challenge lies in coordination between authorities with different remits. And I think this is a double-edged sword. On one hand, you have institutional coordination mechanisms that are less developed in emerging markets, which is obviously a drawback. But on the other, they may benefit from having fewer entrenched rules and less rigid markets. So public authorities can respond to tokenization on different levels, policy, legislation, and regulation. Each of these play a distinct role and has a set of unique considerations which we dive into within the report. Okay, so given where things stand, where are we headed with tokenization? So in the report, we have evaluated in depth the challenging market infrastructures that tokenization provides and the roles, and have discussed a set of future scenarios for disintermediation of capital markets. We analyze these using two variables, the level of usage. So that is the rate at which capital markets implement solutions to leverage tokenization to improve market functions. And the degree of interoperability. So the degree in which participants of tokenized platforms and markets easily interact with each other. And on a combination of these, the future of tokenized markets could be either of high usage, so with access to settlement assets such as wholesale CBDCs, and low on-chain interoperability, a scenario with high usage and high interoperability. And finally, you could have a state with low usage and high interoperability. So in all of this, the question is not really whether tokenization disintermediates capital markets. It is actually whether particular intermediary roles are reduced or reconfigured. And as an instance, this is how financial markets look like today. We have incumbents such as dealer banks, exchanges, custodians, central security depositories, central banks, each of whom play their traditional roles. But in a scenario with high usage and high interoperability, markets could transform majorly with significant disintermediation of post-trade services. So activities start to vertically integrate within a single interoperable tokenization platform. And where intermediaries develop applications to deliver new products and services to their clients, this may end up replacing or competing with traditional forms of liquidity provision. So we think that this will inevitably lead to re-intermediation with the emergence of new institutions and new roles. So eventually, in our opinion, the structure of tokenized capital markets will be shaped by at least three forces. First, the technology itself that generates new dependencies and new categories of intermediaries. Second, market participants who may respond differently to these possibilities, either by embedding tokenization within existing business models or using it to bypass or reconfigure them. And third, regulators who may influence these developments through legal and regulatory reform. But despite these developments, regulators have viewed tokenization cautiously. So the general framing across our surveys, roundtables, and interviews is that it is an evolution within existing capital markets rather than a standalone innovation. And it's interesting that no single regulatory model has emerged for tokenization across emerging markets. The approach is broadly divided into three camps. The first group is adapting existing securities and capital markets law to accommodate tokenized instruments. The second group is enacting bespoke legislation, which covers issuance of tokenized real-world assets. And third, which is perhaps a larger group, is using regulatory sandboxes as a learning mechanism before committing to formal rules, which again, obviously takes various forms and approaches. So very mixed set of approaches indeed, and the interviews reflect the story. So given these variances, where and how should a regulator respond? So since developing the approach for tokenization of financial activities and instruments is a complex exercise, instead of providing a set of static recommendations, we felt that it was more useful to develop a toolkit to support the development of a regulatory approach. And to make it more concrete, we used cold tokenization as a use case, where we find that responses in terms of regulation should be a combination of product and activity-specific interventions, which is unlike what we see in markets today. So tokenization is very much a horizontal application of rules rather than vertical. And this tells us that by treating tokenization as a cross-cutting topic, we create a flexible exercise that produces actionable steps for regulators to address policy challenges. Now, I want to highlight a particularly interesting dissonance in our findings across institutions when it comes to strategic priorities for tokenization. So we asked regulators and market participants to rate out of 5 the strategic priority they assigned to tokenization. And market participants rated it a 4.5, whereas regulators assessed the actual market activity at just 2.1. So this gap, which we call the perception gap, between how ready the industry feels and how much activity regulators can see, is, I think, in many ways, the key question that the report explores. And in our view, the regulators have tended to view tokenization through a financial sovereignty lens, whereas industry sees this as access to new forms of capital. And bringing these two together is very much the key to developing a minimum viable ecosystem for tokenized markets. And with that, I bring this presentation to a close. Our report is now available online and can be downloaded via the QR code on the screen. Thank you so much for your time, and Hugo, back to you.
Many thanks, Keith and the team for the presentation. We will now proceed with the panel discussion. The panel will be chaired by Agustin Carstens, who is one of the co-conveners of CDIR, and as you all know, the former general manager of the Bank of International Settlements. Hello, Agustin. Agustin is going to be joined by Danny Ryan, president of Ethereum, Jane Moore, head of the Department of Payments and Digital Assets of the Financial Conduct Authority, and the people among us who deserve a holiday and still agreed to join us on the day the FCA published their policy statements on crypto asset policy. And then Lyle Orsley, the divisional head, FinTech and executive manager of the South African Reserve Bank. Pallavi Thakur, from a director of industry engagement at SWIFT, and Siddharth Shetty, chief executive officer of the Finternet Labs and one of the co-creators of CDIR. Thank you all. Agustin, I hand over the virtual mic to you.
Thank you. Thank you very much, Hugo, and good morning to all of you. As a co-convener of the CDIR, I welcome you to this second forum. It is a real pleasure and honor to chair this panel. Well, as you know, I have been involved with policy matters for many, many years. Up to last year, I was General Manager of Bank of International Settlements, and in that capacity, I have been very, very much engaged with all the developments of technology and their applications into financial system. And with my good friend Nandan Nilekani, we wrote a provocative paper about the Finternet, and as a matter of fact, with the help of Siddharth. And I'm glad that this, not only this topic, but many other inspiring work has led us to the point where we are today. I think what we are discussing today, in a way, is testament to the progress that this debate has taken place, and to bring all these ideas into reality, not only the Finternet, but whatever it needs to make the financial system more inclusive, more efficient, and so on. Now, in this discussion, distributed ledger technology started at the margins of the system before financial institutions and central banks started experimenting and adopting it. Questions remain about how widely DLT will be adopted and be used, but I'm convinced that DLT and tokenized instruments such as stablecoins have a role to play in the financial system. And given what we have seen in the last years, I can, with fair degree of certainty, say that they are here to stay. In saying this, I'm not glossing over the risks and challenges. The full promise of DLT will only be realized if the systems built on it meet the standards we require of any critical financial infrastructure. This includes settlement finality, because a system that cannot deliver irrevocable transactions does not work. Scalability, to manage half volumes with low latency. Resilience against manipulation by malicious actors, and interoperability with both DLT and non-DLT systems, so that we do not fragment the liquidity of the markets. This is not an exhaustive list. These are probably the main issues to be challenged, but nevertheless, we need to move forward. The research from CCAF brings together the perspectives of three relevant groups: market participants, infrastructure providers, and public authorities, and in all of these matters. It also shed lights on the incentives and challenges of emerging market and developing economies, which are not always adequately represented. It is a welcome contribution to the public debate, and more concretely to our discussion today. Let me set out how we will proceed with the panel discussion. I would like to organize the conversation in three parts. First, we will be looking at market developments and use cases. Second, we will turn to the risks and challenges tokenization creates including the risks associated with distributed infrastructure. And finally, we will discuss the possible regulatory responses. We have more or less an hour to go. I'm very ambitious in terms of the number of questions I want the panel to address. So without being telegraphic, I encourage you to give concrete answers. So let me start in the section A. Let's about 20 minutes in this, and let me start with a question for Jane. The FCA has published a significant package of proposals on digital asset markets. The industry has long called for regulatory clarity as a precondition for scaling responsibly. So the question is, what impact do you expect recent initiatives to have on how the market develops from here?
Thank you. And thank you for inviting me to join today. And as Hugo says, this is a day where I should have holiday. We have published in the FCA the policy statements for the crypto regime, which includes stablecoins and hopefully will progress tokenization. So just to spend a minute on the policy statements that we published this morning. I hope that so some of the participants in the audience here have seen them. If not, please do look them up. We published 5 policy statements setting out our rules and guidance for regulated crypto asset activities, for stablecoin issuance, for emissions and disclosure and market abuse, for prudential requirements, and applying the FCA handbook. We've published a number of pieces of guidance which will help firms apply our regime on the consumer duty, on operational resilience, and on our approach to international crypto asset firms. Along with that, we have published with the Bank of England a statement setting out how stablecoin issuers will be jointly supervised by the FCA and the Bank of England. And as well as that, if that wasn't enough, we've published a cost-benefit analysis covering the whole of our crypto asset regime. So firstly, I think that this will provide the certainty that firms have been calling for to scale responsibly. The rules that we've published today are the FCA's regulatory regime that sits on top of the legislation that was published by Parliament in February. And every firm conducting crypto asset activities will need to be authorised in the UK from the 25th of October next year, 2027. Our gateway for firms opens on the 30th of September this year, and we will be welcoming applications from across the crypto industry to become authorised and to scale and grow within the UK. We are offering a number of services to firms to provide help and support, and we have the pre-application support service that's open now. So the application window for firms opens from the 30th of September to the 28th of February next year. Focusing slightly on stablecoins, we have set out the rules for non-systemic stablecoins. In the UK, we will have the stablecoin regime will be split into 2. There's non-systemic, which the FCA has published, and the systemic, which the Bank of England issued a paper on last week. So what do I think this will do to the market? I'm hoping that this gives the certainty and it gives the regulatory clarity that industry has been calling for. I'm also hoping that it responds to a number of the comments and feedback that we've had from industry because we've consulted extensively and we have listened to the feedback and adjusted our regime where we think it is right to do so, to give a regime that delivers consumer protection, delivers market integrity, delivers trust, and it allows for innovation. So I am very hopeful that this will allow the market to develop, for new products and new use cases to emerge, and for us to then move forward and have a thriving digital assets market and tokenisation market within the UK.
Well, thank you very much, Jane. And I really congratulate you and the FCA for putting together this very significant package of proposals that I'm sure will move us in the right direction. Now let me move now to my good friend Siddharth. Hello, Siddharth. Great to see you again. So Siddharth, zooming out to the global level, where is tokenization delivering real value today, and how do we see the sequencing of use cases for tokenization? In other words, what comes first and what might follow?
Great to meet you and see you as well, Agustin, and all my fellow panelists. Really grateful to be a part of the discussion today. Before I dive into answering the specifics on tokenization itself and where it's adopted, what I want to do is take a step back and really put in place the context around how this technology is emerging. Because when we look at technologies more broadly, the context is very critical. You go back to the early days of electricity, when we were transitioning from steam engines to actually being powered by electric power. You saw factories where traditionally they were centrally organized around steam power. It took a few decades for factories to reorganize around electric power and the sort of subcomponents that could all be created using batteries and so on. And when you look at technologies like biometrics, you could look at it from the context of surveillance, you could look at it from the context of border control, you could look at it from the context of inclusion. And a program like Aadhaar went on to create 500 million bank accounts by giving over 1.5 billion people digital identity using biometrics. So I feel it's really important for us to place technologies within the context of what they finally unlock. And I think when we think about tokenization, it's really important for us to look at the entire internet today, and all of digital financial technology has so far been primarily designed for humans interacting with these systems. We are very soon going to move into a world where it's basically agents interacting with these systems. It's not going to be 8 billion humans, it's going to be trillions of agents interacting with the financial system, authenticating, authorization, creating a whole range of transactions. And we're already seeing creaks at the edges. If I take a simple financial flow, like let's say KYC, know your customer, was traditionally designed for humans. They'll create documents, produce those documents to a financial institution, they would verify that. Now with AI, in all cases, you can deepfake and therefore create fraudulent documents with a click of a button. Those workflows start to fail. When we look at KYC, it was traditionally done in a very siloed manner to each financial institution. You don't have the ability to, across the board, analyze how fraud is happening because it was difficult to share data. Now with new cryptography unlocks driven through tokenization, you can actually map out flows across the financial system while preserving confidentiality. So I think when we look at tokenization, the way I see this playing out is really in a world where trillions of agents are interacting on our behalf, they will need verifiability. They will need transactability. They operate 24/7. They don't go to sleep or they don't take a break on the weekends. And so when they are representing our interests, ours as individuals or ours as businesses, the underlying substrate of how financial flows are orchestrated today, which are typically high transaction cost in most cases, maybe real-time payment systems are sort of one area which are a lot more innovative, changes these dynamics. So that's sort of how I look at this playing out. I think in the micro, the report talks a lot about the here and now use cases of stable coins, certain types of tokenized capital market instruments, etc. But eventually, I see this as fundamentally the substrate. And if we look at all the characteristics that tokenization unlocks when we think about programmability, humans don't really need a lot of programmability. We can't deal with different workflows. Agents would. You may be doing a transaction, an agent could bilaterally spin up an escrow on the fly. Very difficult to do today, very high cost. So I think if you look at verifiability, if you look at each of these characteristics, interoperability, why is there a need to interoperate between banking, capital markets, insurance? A lot of these flows start to become obvious when we work on the use cases agent backwards. So that's sort of how I see this playing out. I think we'll see early use cases. Some of them have been more speculative. Some of them have a whole range of other benefits like stablecoins and so on. But we really need to look at this in the context that you're going to have trillions of agents interacting with the financial system. And so tokenization is a very critical substrate.
Well, thank you very much, Siddharth. And in a way, it's encouraging, but also scary, this quantum leap from millions to trillions of agents. And I'm glad you bring this issue to the table. Now let me move to Danny. Danny, which asset classes or financial activities are currently taking place on L1 networks? What assets are being tokenized, and what institutions are using it?
Right. By and large, the most interesting assets so far on blockchains have been cash, and we talked about it a number of times. Simple transfers, lending, asset purchases. But beyond that, I think it's been largely uninteresting. Real world assets have largely been funds, money market funds, credit funds, in highly restricted access and use cases. Additionally, we have a number of public assets that look kind of like their counterparts. They have unclear rights, but and sketchy redemptions. Can I vote with my stock on chain? Maybe, maybe not. Can I get the redemption of the underlying? I hope so. And this is firstly because the technology has largely just had to take time to mature, and these are the obvious use cases and the obvious paths. But also, I think there were massive chilling effects on DLTs and blockchains in general. And really beginning to upgrade capital markets, we can only really begin to think about doing that recently in massive global shifts of what people are doing on top of blockchains. So I think in the past year and a half, there's been a race behind the scenes to truly get the benefits of open, permissionless, and programmable networks. It turns out that if you have a single source of truth, native programmability, and a common shared database, a blockchain, a DLT, then you get a lot of the pain points from the digitization of finance over the past couple of decades just begin to fall away. Asset level tokenization, I think, is where we're going. Encoding all of the rules of a market, all of the rules of an asset on themselves. This is the exciting stuff. And this is where we're seeing the most interesting things happening behind closed doors. And I think where we're going to begin to see a lot of the actually exciting stuff happening even this year. And I think once you have asset level tokenization, rather than fund level, rather than these derivatives or strange objects on top of the underlying, that's where we're going to begin to see massive innovation on top. You're going to start seeing delivery versus payment of the underlying asset, atomic transactions. We're going to see more and more of the functions of these assets and markets move towards protocols. AI speaks protocols as their native tongue. And I think the world largely in the financial world is going to look more and more like protocols. And then we'll see derivative structures, structured products on top of the underlying, and begin to have global distribution of real yield and real underlying rights. And this is the exciting stuff. And I think, the foundation of the past 10 years is getting us to this point, but most of the interesting stuff is in progress rather than already on these L1 networks.
Well, thank you very much, Danny, and certainly we're looking forward to what comes next. It certainly will be really exciting, not only because of the trillions that Siddharth mentioned, but also on the breadth and scope of what will come next with the tokenization. Now let me move to Lyle. Much of the current debate on tokenization is framed from an advanced economy perspective. How does the picture differ for emerging markets? What does adoption look like in an economy such as South Africa? And I'm glad you're here because you are a real authoritative voice from a central bank point of view, and certainly coming from one of the leading central banks in emerging markets, the Reserve Bank of South Africa. So, please, the floor is yours.
Thank you so much, Agustin, and thank you so much for having me. So from a South African perspective, we certainly are seeing growing interest and adoption in tokenization. and in crypto assets more broadly. And so this interest, I think, is coming from your traditional financial institutions and also from your crypto players. So we have taken steps to regulate crypto assets, and we've done this in a phased way in South Africa. And currently we have, I think, close to 250 licensed crypto asset service providers in South Africa. And so I think through recognizing crypto assets as a financial product in South Africa and then licensing crypto asset service providers, I think this has had two important impacts in our markets. The first is that it's provided licensing pathways for entities that want to offer crypto products. And so we've seen stable coins coming to our market. We've seen tokenized instruments being offered by these crypto asset service providers. So tokenized shares, tokenized bonds, tokenized gold. So these are all offered on the platforms that are operated by crypto asset service providers. But these are largely offered through this intermediary-based framework, which is something that the paper raises as well. And then the second, I think, big impact is from your traditional financial institutions that now have more legal clarity in terms of, how crypto asset is viewed as a financial product. And they are able to then interact with licensed crypto asset firms as well. So I think this then paves the way for your traditional financial institutions to also expand into offering digital asset services and leveraging the underlying technology to enhance the services and the products that they offer. So we've seen that our banks are looking to provide custodial services for crypto assets or digital assets. We've seen that the banks are looking to explore, stable coins backed by commodities to enhance cross-border payments, for instance, and also exploring blockchain-based solutions for offering tokenized ETFs. So I think this, Jane touched on it earlier, providing this regulatory clarity, I think, provides these pathways for licensed activities. And I think it then enables the traditional financial ecosystem to also play in this space with more clarity as well. I think the one thing that we do have to think about then, definitions do matter. And so we view all of these things. Are they all crypto asset related activities, or do we think about them in different segments? There's crypto assets, stable coins, tokenized real world assets, natively tokenized instruments, because I think that they each do present different legal considerations as well. And I think from where we sit in South Africa, at least, the evolution that we are going through is to say, we have a framework for crypto assets broadly as a financial product. But how do we think about when we move towards your capital markets frameworks, and how do we think about the evolution of our securities framework to more appropriately address, tokenization of your financial instruments, whether they are bonds, whether they are securities. And that's a piece of work that we are currently focused on. And I think that clarity in the securities world will unlock even more use cases and adoption in the South African market as well. Thanks.
Well, thank you. Thank you very much, Laila, and thank you all of you who have participated so far for being extremely disciplined with the time. So we're right on time to move to section B, where we will discuss risks and challenges. Lyle, you provided us a very good answer already about what has been happening in South Africa. In a way, what has been the progress, but progress doesn't come without risks. So let me build on your previous answer, and could you please specify precisely the risks of tokenization for emerging markets? And then, just to underline what you think are the most important opportunity that this presents. I mean, you already have gone on this, but if you could elaborate a little bit more, would be very appreciated. Lyle, again.
Sure. Yes. So, I mean, I think there are a few things that we are having to think about. So the first point I'll make is that South Africa has a exchange control framework or a capital flow framework in place. And I think this is quite unique. Many advanced economies do not have capital flow measures in place, but many EMDEs do. And so this is in place to ensure effective control around the movement of financial and real assets into the country and out of the country as well. So digital assets being borderless, being that they operate, 24/7, 365 days, and that it enables value to be transferred near real time across borders. This really challenges a country that has, a framework in place around regulating, what comes in and what goes out of a country. So digital assets present challenges for how do we approach them in terms of our existing capital flow framework. So that's the first area. The second point is around stablecoins. And here we think about, there's stablecoins that are pegged to the local currency. And we have some of those in South Africa. We have about 8, stablecoins pegged to the local currency. But then we also have growing adoption and use of stablecoins that are pegged to foreign currencies, particularly the US dollar. And we see this growing adoption around these stablecoins being used to gain exposure to a foreign currency, to hedge against any domestic currency risk, and for cross-border payments as well. And so if we do see wide-scale adoption with, a foreign currency instrument in this way, I think it does raise challenges or questions around the potential for currency substitution, and potentially undermining monetary sovereignty. It can also create, a parallel system where you have an instrument being used for payments and settlement that's not sitting within the regulated payment system. So there is a risk of potentially having, this parallel system that operates. As I mentioned, stablecoins too present a risk around, capital flow, and potentially having this value being exported out of the country in a way that you couldn't export value out of the country with a traditional currency, or if you were to try and use, a traditional currency. And then, of course, there's the risk around, undermining your money laundering and those controls and measures that you put in place, given how quickly value can move, given the pseudonymous nature of the underlying technology. There is a risk that you potentially can have, your controls around mitigating money laundering. Those can also be undermined. So those are the main things that we are thinking about when we think about how to approach these digital assets. But I think also there are opportunities as well. I'll just touch on a few from a tokenization perspective. We do see the potential, for tokenization to lower barriers to entry and to lower your investment thresholds. And this can happen through fractionalization or through the ease of use of using these technologies and being able to distribute assets to, wallets. And that can enable broader access to financial markets, and that can then support financial inclusion outcomes and expand your investor base as well. If people are able to access a broader range of products, you potentially do have, a diversified range of assets that can sit within your portfolio, and that too can sort of deepen financial inclusion. There is also, if you move from a system of multiple intermediaries, multiple databases, and if you have something that can exist on a shared ledger that's programmable, that can simplify your market structure, it can bring more transparency, and it can enable more efficiencies within the ecosystem. And that can potentially lower costs as well. So if we can reduce some of the complexity, if we can reduce the frictions within the existing architecture, then I think those are good positive outcomes as well. And if you can potentially unlock liquidity in assets that were previously illiquid, again, I think that can deepen market depth. And again, these are all positive outcomes for your market structure. So those are some of the things I think that are exciting for us from a benefits perspective, but of course to manage it against the potential risks as well.
Thank you. Thanks very much, Lara. Yes, the issue of sovereignty is a big issue. It lends itself for a panel discussion by itself. Now, let me move to Pallavi Thakur. Hello, Pallavi. Good to see you again. Let me give you a little bit more of time because I want to ask you about not only the risks, but also about the opportunities and what SWIFT has been have been doing. So SWIFT sits at the center of cross-border finance and has now committed to a blockchain-based ledger within its core infrastructure. How is tokenization reshaping market architecture, the roles of participants, in particular the position of incumbent FMIs? And in a way, if you can also go forward and tell us if does DLT materially strengthen systemic resilience, or does it risk sharing and potentially obscuring single points of failure? And in an increasingly fragmented landscape of market infrastructures, what should resilience mean in practice?
Great. Thank you very much, Dr. Carstens. And yes, good to see you again. And thank you, CCAF, for the opportunity to speak. I'll probably follow what Siddharth was doing and take you a little bit back in history and remind you like in how things are in the two-tier monetary system. So we've got roles and responsibilities defined for a bank, for a central bank, for custodians, exchanges, CSDs, and this was also being presented as part of the presentation earlier, that with DLT and tokenization, some of this market structure is changing. And initially we talked about disintermediation, but right now I think there's a lot of opportunity for reintermediation. At SWIFT, we see this as an opportunity, and Light was also talking about opportunities, and this is clearly an opportunity for us as incumbents in this space. So we've actually embraced this technology to improvise our network to enable end-to-end 24/7 payments. A lot of time people when talk about SWIFT, they actually don't realize that SWIFT in many ways is a peer-to-peer network. We are a network of 11,000 financial institutions globally. Now, by adding a blockchain-based ledger to our technology stack, what we are now able to do is basically orchestrate payment messages between financial institutions in one atomic transaction, leveraging SWIFT connectivity and gateway. And this allows us a faster time to market as compared to others, as I said, given that we are a network of 11,000 institutions. So going back to market structure, yes, tokenization has actually given us the opportunity to really rethink our position as an incumbent in this space and use this as an opportunity to evolve ourselves from a technology perspective. Now, coming to your second question on resilience, and I think this was a new topic very close to my heart. We discussed it at length at 0.0 Forum, and you were there. But again, let's talk how resilience is there in today's world. When we talk about resilience today, you've got domestic or cross-border infrastructure, very centralized systems. They are built and operated by a single entity. You can have a technical operator, but you always have a governance or a governing entity around it. Now, for these infrastructures, the existing infrastructure, there's always a business continuity plan. You've got multiple levels of resiliency built in. But in today's geopolitical scenario, and again, going back to the numbers of trillions of agent and AI-related cyber hacks, the threat of quantum, and I think resilience strategy needs to be revisited by every institution. DLT, to your point, definitely has an edge over here compared to other traditional technology, the decentralized distribution removes the single point of failure. So there'll never be a situation where a single operator can fail or can be compromised. However, what we really see in this whole decentralized nature is that risk shifts somewhere else. So the risk is now shifting to decentralized governance, or basically in a network where you have sequencer and you've got validator nodes. You've got risks sitting there now. So the risk has basically shifted to a new position. Now, in an event of a market failure, or if there is a crisis, a system will recover fast only if there's a strong governance or basically a decision making, right? Like today, if something goes wrong, a governor can call up a technical operator to say, what's the SLA for the system to come back up? But in a decentralized systems, we don't really have, and that's the piece where, and I think the report, the CCAF report also identifies that governance is absolutely critical if we want this DLT-based infrastructures to be as resilient or probably more resilient to how centralized systems are today. The only other point that I would also add here, and also it goes back to the point, to your opening comment, Dr. Carstens, in terms about fragmentation. Excessive fragmentation, we all know, is not good. We see new networks coming up every day, which means protocols which do not interoperate natively, leading to fragmented liquidity, different operating models and governance. Now, in such scenarios, it will be very difficult to coordinate recovery in a market failure. So in my personal opinion, I think it would be good for the community to basically rally behind a few networks, few really strong and resilient networks. A tiny bit of fragmentation is good because it promotes optionality for end users. It's also healthy competition between the operators of those networks. It also allows for business continuity. Should something goes wrong with one network, you can always move traffic to another network in a crisis. Those are just my thoughts around resilience. Decentralized governance takes the highest priority when we really have to think about resilience in a DLT-based infrastructure.
Well, thank you. Thank you very much, Pallavi. And I'm really glad all the work that SWIFT is doing around infrastructure. I think a huge challenge that we face as we move forward to really grasp all the advantage of tokenization is to really develop the technology and the infrastructure that is needed for that to happen. So I'm glad all the work that is being done over there in SWIFT. Let me now move back again to Jane. So Jane, enabling the adoption of new technology and infrastructure while managing the risks it introduces and ensuring consistency with existing frameworks has proven a challenge for regulators for several years. In your view, have we found the right balance?
Thank you. And as a regulator who's today put out policy on this, I'm hoping that the answer is yes. So focusing on crypto for a start, I think this is a journey that we need to go down through crypto, through DeFi, and looking at tokenization as a whole. We have looked at same risk, same regulatory outcome. We've drawn on existing regulatory approaches. We've adapted them for the reality of DLT and for crypto. And we have used the solid foundation that we have in existing financial services regulation to build our regime. Where consumers, customers are at risk of harm, we've addressed that. We've addressed it through specific rules and guidance. So, for example, operational resilience, something that we've been highlighting, is absolutely key. And we have applied in the UK our existing operational resilience framework, but with additional guidance. We've found a balance by also consulting extensively with industry, with trade bodies, with consumer groups, with stakeholders right, left and centre. And so I think we have found the balance that is right for now. And hopefully by adopting an outcomes-based approach, it's a balance for the future. But I'm also conscious that innovation is happening. firms are developing use cases, and we need to make sure that regulation stays right for the products that are coming and provides the right framework and grounding for the new products and use cases for the future. One thing that we're using to develop this balance and to input into our regulation are sandboxes. So just focusing for a second on stablecoins, we invited stablecoin firms into our regulatory sandbox, and as they've been testing within the sandbox, we've been learning from them. So from a policy perspective, we've used the reality of sandbox testing to deliver our regulatory regime. That's the UK regime. I just want to quickly touch on international regimes. Crypto is global, tokenization is global, and we need to have a global response, which is why I think there's a really significant role for global standard setting organizations and the international recommendations that have been published and any that are to come. Because I think they provide a baseline of regulation on which jurisdictions can build, and that helps set that balance so that all consumers across the world have the right level of protection, but equally innovation can be embraced. I wanted to just highlight the IOSCO recommendations, crypto and digital asset recommendations, which the UK was very proud to lead, and also the other recommendations that are applicable from the FSB and also from FATF. And I think that does provide consistency internationally as well, where regimes are based on these on the right standards. So I think there is more to be done. I think there is a journey as to how we consider, as a globe, crypto regulation holistically and how we consider tokenization holistically as well, so that we can build the right frameworks and regulation can help mitigate the risk, but also, as you say in the question, provide that right balance. For tokenization within the UK, we've issued a call for input. We're learning from the crypto regime, we're learning from the existing regulation of financial services and capital markets, and hopefully we will find the right balance for tokenization as well. Thank you.
Thank you very much, Jenny, in particular for bringing to the fore the global nature of the phenomena we're dealing with. And thank you for also making the call for the standard setters to basically improve their game in this respect. And in particular, I underline the importance that emerging and developing countries do not fall through the cracks. I think that's also of the essence. Now let me move to Siddharth. You have argued for open and interoperable infrastructure. What risks do you see in the design of the underlying infrastructure, including the choice between permissioned and permissionless systems?
So the way I look at that is, when we think about the choice of permission and permissionless, it really comes down from an underlying place of control. Who controls what and how does that manifest? Before I go down the path of actually answering control, I think it's important we realize that today billions of people continue to be held back from accessing the financial system as a whole. We've been talking about emerging and developing economies. A lot of the work we've been doing, there are over 100 countries that have a population less than 10 million. They don't have the ability to build financial infrastructure from scratch. And it's let alone build, but it's build, operate, effectively supervise, monitor, and enforce the entire chain. And in most cases, because of the lack of that capacity, they're often then, held back, or their citizens and their businesses are held back from accessing these opportunities. And this is across the board. I think collectively, the financial ecosystem did a really good job in pushing for financial inclusion when it was just limited to opening bank accounts, although there's a little more that can still be done. But what happens to broader financial accounts? What happens to investment accounts? What happens to people being able to participate in insurance and all of that in a more democratic manner? So when we look at it from that lens, which is there are billions of people that need access to a lot of these financial opportunities. And then we start to think about this gap between permissioned and permissionless. I think it changes how we look at it on a couple of dimensions. One is, I think, permission and permissionless really came up from the cryptography blockchain world. But I think it causes a bit of confusion because, what do we mean by permissionless and who says what is permissionless? So the way I like to look at it is, one, in terms of universality. So the base infrastructure, when we think about settlement and when you think about public blockchains, for example, what they're enabling is greater universality of settlement across different types of assets, whether that's money, whether that's equity, so on and so forth, and universality also across jurisdictions. So if countries don't have infrastructure, they can use this without starting from scratch. That being said, yes, different financial instruments will have different characteristics. So for example, let's say I'm a founder at a company, and even if my stock is tokenized and issued on a permissionless environment, it cannot be that a random person in another jurisdiction can purchase that stock because there are inherent rules in these financial instruments. And so I think it's really useful when we think about permission and permissionless is to imagine the infrastructure to be as open as possible, much like the internet. In the old days, banks and others would set up their own cables and set up their own version of the internet. Today, everyone plugs into that. But then you layer rules on top. Who can access the system? What can be issued? What is the nature of transactions? How does identity get validated? What are the transaction limits? Depending on the financial instrument. So we'll have permissioned flows, permissioned asset flows on fundamentally open, universal, or what's traditionally called permissionless infrastructure.
Excellent, excellent. Thank you very much. Certainly, that's something we need to work on. Now, let's move to Danny. So, Danny, what distinguishes a sound layer one network from others, and which operational risks do you think the industry still underestimates?
Right, and I have to echo what Siddharth said. I think one of the most important lenses of a sound layer one network is really that aspect of control. Is it mature? Has its security model and a lot of the technical underlyings been proven and battle tested, been analyzed by academics, been utilized in many different settings, been hardened through hacks, recoveries, standards, and processes. But ultimately then on top of that is really this aspect of control. And I think the simple lens to assess that is how likely is someone to upgrade the core of their business or the core of even a critical market with such a blockchain or such a DLT. And institutions might distribute assets on chains and environments where there might be, wherever there might be a demand for distribution. But really, for the transformative use cases, for the things that upgrade the core of the reality that these institutions are utilizing, institutions require neutrality, and they require underlying infrastructure that doesn't have that element of control. This is obvious when I speak to large U.S. institutions across sectors. They don't want to build on somebody else's environment. They don't want to be beholden to whomever controls that master switch. But it's even more obvious on a global scale. Does a Hong Kong bank want to upgrade their back office operations on a chain controlled by a US company? No. Does the LMA want to issue and standardize European bank loans on a chain controlled by foreign banks? No. And in the crypto native tongue, we often use the word decentralization. And it just turns out that those properties actually map towards things that sovereign nations, large institutions, and on a global scale that we actually care about. We care that no one entity, no one company, no one country controls the foundations, that nobody can censor transactions, alter execution, or even change the underlying state. And that's kind of the entire point, like to eliminate counterparty risk at the base layer, to make the internet of value neutral, like the internet itself. And when you do get those things, you get the elimination of counterparty risk at the underlying, you get incredible uptime, you get security that you can analyze in absolutes, not in kind of like soft agreements. And you get mature applications and standards and libraries, and you get no global network effects and liquidity. In terms of operational risks, I don't know. I mean, I work on and build on Ethereum. I believe that Ethereum meets those needs in terms of being ready for prime time, being able to write secure smart contracts that can secure billions on top of a neutral infrastructure. But I will say when I speak to institutions, I think a lot of the operational risks are in the layers on top of that. Key management, fail safes, programmable recovery. There's this whole institution of financial custodians and insurance and security in the kind of the classic sense. And then there's extremely secure crypto constructions, multi-party computations, shared keys, design standards for upgradability and governance. But these worlds have to meet in the middle. There's very few financial custodians and intermediaries that are well versed in the complexities of even custodying stablecoins beyond just a simple transfer, much less dealing with the complexities of complex smart contracts. And then if we go back into the world of AI and the world of agentic finance, that world becomes compounded even more so. What are the controls of a programmable AI agent interacting with smart contracts, potentially moving $100 million workflows? And so there's a lot of this kind of operational layer that in the applied cryptography space, we have solutions. We have a lot of this mapped out and well understood, but bringing it into and integrating it into kind of the classic cradle, there's a lot of work to do. And there's some forward-thinking players, but it's going to be a stepwise upgrade for a lot of the system that still needs to happen.
Needless to say, yes, there is a lot of work to do. Thank you very much for your response. Now let's move quickly to the regulatory responses. I was quite permissive talking about permissions in the previous section, so I ask you to be a little bit more compact in this section. Now let me this section about regulatory responses. Let me start with you, Siddharth. Regulations, as Jane mentioned, regulators defend the principles of same activity, same risk, same regulation. From the perspective of someone building these systems, does these principles still hold?
So I feel directionally the principle is right, but the devil is really in the details. So if we take an example, let's say tokenized deposits. So directionally, you would want tokenized deposits to map similar to how deposits are managed in a more, say, digitized manner as well, right? But now when you get into the details of what it means for that deposit account to be tokenized, where is it tokenized? So some of the risks that Danny mentioned in terms of, 24/7 real-time nature of people being able to transact. So hands, money could move across hands very quickly. That introduces this new type of risk. Smart contract risks when it's being tokenized, so on and so forth. The risks on what chain or what DLT itself it's being issued on and all the security characteristics or decentralization characteristics behind that. So I think you have new operational risks that come up. While yes, some forms of risks like traditional counterparty risks or traditional settlement risks may have gone away because technology changes the nature of that. And so I think the way to look at it is directionally, yes, tokenized deposit is practically the same as a deposit. But if we effectively need to unleash that on the market, you need to look at these operational risks. Along with that, two other points I would make is the changing nature of technology is fundamentally unbundling a lot of functions. So when we think about functions like issuance and custody and all other functions that were implemented by intermediaries around capital actions and so on and so forth, technology is changing that because it's causing unbundling. So more actors can do parts of this, very classical sort of Adam Smith division of labor. And so therefore, again, the nature of regulations and who do you regulate and how do you regulate inherently changes. And I think the third part is also technology is introducing a lot of composability, which means inherently, if I tokenize my deposit, that deposit could then be, in real time locked in as a collateral instrument on the capital markets. And so then what happens between banking and capital market regulators, and who's responsible, who says yes, who says no? Can they even say yes or no effectively? You get all of these new emergent risks or emergent properties. And so I think to summarize, we really need to keep in mind that inherently these changes are cross-sectoral. So they cut across banking, capital markets, insurance, beyond financial markets into data protection, competition, and so on. They're cross-jurisdictional because these technologies are global by default. They're not really seeking anyone's permission. And so I would say that the way we want to address this is in a tech-forward manner. So how do you look at regulations? How do you look at enforcement? How do we look at supervision? Being as much as possible embedded within the flow, within the asset flow that's there, because that will lower cost, improve trust, and essentially be the only scalable way to manage this across the board.
Definitely, I agree. We need to embed as much regulation as possible into the process. Let me now move to Pallavi, encouraging again that we're running out of time. How do governance models need to evolve to support resilient tokenized financial markets? Are there limits to what infrastructure can achieve in the absence of regulation?
Absolutely. And keeping to your request for time, I'm going to make 2 points quickly. I think the first one, and I think the other panelists also have highlighted that the nature of tokenization and digital assets is global, right? So it basically needs coordinated effort. And I am hopeful, just like we have the G20 roadmap for cross-border payments, I'm hopeful maybe there will be a G20 rule book for digital assets, because there needs to be a lowest common denominator when it comes to digital assets framework. And then on top, every jurisdiction can build. So let's hope G20 comes up with a G20 rule book for digital assets. Second, coming on to the infrastructure. Traditionally, as we all know, that assets and cash and assets were recorded in databases. So everything, the governance was around databases, like the digitization. But today, tokenization, your instrument and infrastructure can be decoupled, right? I can issue my instrument on somebody else's infrastructure, which was not the case before. Like even at Swift, we are an infrastructure provider. We are now bringing the ledger, which is our infrastructure, but somebody can issue their instrument on the infrastructure. So there is a need for governance to look at this emerging ways of recording and moving values and have the right guardrails or the rule book around things which are actually mentioned in the report very nicely, around ownership rights, settlement finality, legal enforceability of smart contracts, supervisory oversight. This is where regulatory harmonization is like super, super important. And I think infrastructure can only provide speed or automation, but it's only regulation which will provide the legal certainty, trust, and accountability. That infrastructure cannot do it. So I'll just leave it at there.
Thank you very much, Pallavi. Danny, I invite you to give us, and thank you for your understanding, a 2-minute response on a very demanding topic. Which is, what does the prospect of embedded supervision imply for how supervisory practices must evolve?
Right. And I think about this a lot, right? Like we're working on upgrading some pretty major kind of infrastructure in financial institutions, and regulation is critical, supervision and observation is critical. And I guess first of all, don't embed this in networks, right? I think people try to embed this directly into the infrastructure layer. And if we do, we're just going to create islands. We're going to miss the benefits of the kind of that global neutral settlement layer. Instead, embed this directly in smart contracts, embed in controls directly in the assets themselves, and actually get the benefits of a programmable blockchain. The more that is actually, what is codified in law and codified in contracts, you just codified in code, the more we're going to get the efficiencies and massive benefits of programmable digital assets. That said, a lot of the rules of market settlement and compliance of the past 100 years don't actually necessarily make sense when you have a programmable single source of truth. For example, in the US, we have the notion of a transfer agent, someone that facilitates and manages the ledger. Turns out, if you have a smart contract doing that, the requirement of this transfer agent is actually unclear. And we've seen a lot of some of the securities in the US that have moved on chain have higher costs because they have all of the chain costs, smart contracts, management, security, et cetera, and they're doing the traditional transfer agent role as well. So you just this additive function. And so it turns out that a lot of these rules are around a world where you don't have the single source of truth and programmability. And I think we have a lot of, quite frankly, a lot of work to do to modify, extend, or give relief on some of this stuff. And I think with the programmability, we can actually do things and evolve things that are, both legal and reasonable, as well as good for the consumer and good for business. But there's some catching up to do on the regulation and compliance of these we've highlighted quite a bit in this panel.
Excellent. Thank you very much, Danny. Let me go to Jane. Jane, you already mentioned the global nature, the cross-border nature of what we're discussing, and also how regulation, even though remains largely national, it should be cross-border or global. So just very briefly, can you tell us where do you see the greatest risks of fragmentation? And in which areas do you think international cooperation is more urgent?
So I think international cooperation is essential. And I think there are lots of mechanisms already available to regulators to use. So, for example, the IOSCO MMOU. And I think that supervisory authorities and regulatory authorities need to talk to each other. So I think there is lots more to do. And if regulators don't talk to each other, then there's a risk of fragmentation, but also a risk of regulatory arbitrage, which I think should be addressed by regulators proactively, reaching out to each other and discussing the global firms which they are all regulating. So I think it's a question really for the audience, for any regulator who is listening. Are you cooperating? Are you sharing information? And if you're not, please do. As the UK, we are sharing information with the relevant authorities and stand ready to share with other regulators who is in need of that regulation too.
Thank you very much, Jane, and I definitely echo your invitation for cooperation. We have had a really great panel. Thank you all for genuinely interesting and insightful contributions. One of the things that I believe that is important to stress about this debate is that the questions it raises are never just technological. The technology drives change, but the fundamentals of policy remain. We need finality, resilience, and accountability. Now, technology is a great means to achieve those ends. So definitely we need to work leveraging as much as possible with technology, but not forget about the fundamentals of the issues that are being regulated and supervised. What today's discussion also made clear is that none of the challenges we identified will be resolved by any single actor, even not a single actor nationally, but also, needless to say, not a single actor globally. So collaboration and exchange of views and cooperation is of the essence, and bringing together innovators, public authorities, and of course, let's not forget about infrastructures. And finally, we have to be very mindful about emerging markets and developing countries. It's one of the things that technology does is that allows progress in many countries at the same time. Quantum leaps are possible. So there will be relevant players in this field as they are already, and of course they should be taken into account in establishing regulatory and infrastructure requirements. So let me close with this. I want to thank you all for very interesting exchange of views. I think very good comments sort of give us some light about the future forms of this. I think that several ideas were presented, or several issues were presented that still do not have an answer, and that for the CDIR and others should really address these issues as we move forward, and hopefully we will be able to discuss these issues in subsequent forums. So with this, Hugo, let me pass you back the floor.
Thank you, Agustin. Thank you. We gave you a very challenging task of asking all these questions, and you managed to do so while keeping us on time. I'm very grateful for that. And I would like to reiterate the message of thanks to the speakers for giving us their time and sharing their perspectives today. So this brings us to the end of the forum. You can find the report on the CCAF webpage. I also wanted to take this opportunity to share with you information about some of our forthcoming initiatives. Very briefly, CCAF is launching a new cohort of its digital asset courses for regulators and market participants in September. You can find information on this online and by scanning the QR code on the screen. On the CDIR side, we're launching a hackathon on the 8th of July, looking at the use of agentic AI by regulators. So, in other words, to what extent regulators can make use of AI as they oversee and as they rule and oversee over a financial system that uses AI itself. And the following day, so on the 9th, we're hosting another policy forum on the theme of computational regulation. You can register by following the link that my colleagues have posted in the chat. We look forward to seeing you again at some of these events. Once again, thank you very much for joining. Have a rest of a good day.
Thanks, Hugo. Thank you, everybody.
Bye-bye.
Thank you, everyone.
Thank you all. Bye-bye.
Bye.